As of Saturday, August 8, 2026, the equity markets are closed for the weekend. Tesla stock closed its most recent official trading session on Friday, August 7, 2026 at $328.58 per share, representing an intraday upward movement of plus 2.83% or $9.05 above the previous close, with after-hours trading holding stable right around $328.85. While retail traders celebrate Friday's green candle, the real story quietly playing out behind the scenes isn't about car deliveries or quarterly margins. It is about a massive structural divergence between institutional accumulation and retail volume that suggests Wall Street is pricing Tesla stock less like an auto manufacturer and more like a high-margin software infrastructure utility. When you talk to most investors, the consensus expectation around Tesla stock is remarkably straightforward. People think the company is locked in a margin squeeze, fighting off cheaper electric vehicle alternatives across international markets and relying on pure hype to support its valuation multiple. That narrative makes complete sense on paper if you only look at traditional automotive metrics, but the underlying market reality paints a vastly different picture. When you pull back the curtain on order flow and option flow across a major trading platform or individual brokerage, you notice that large institutional money managers are actively accumulating shares whenever retail sentiment dips. Wall Street isn't buying Tesla for its current vehicle sales. They are quietly placing bets on software recurring revenue, energy storage grid buildouts, and autonomous compute dominance that the average retail trader isn't factoring into their daily watch list. Look closely at the recent stock movement over the past few weeks to see how this dynamic plays out in real time. We have seen sharp intraday swings where Tesla stock traded between daily lows near $321.25 and daily highs reaching toward $333.73. On Friday alone, trading volume topped 39.4 million shares. What stands out isn't just the sheer liquidity, but who was taking which side of the trade. On retail platforms like SoFi Invest, SoFi Active Investing, and Robinhood Stock Trading, retail traders were selling into early morning surges to lock in small wins. Meanwhile, institutional desks utilizing the Interactive Brokers platform and Fidelity brokerage routing were absorbing that supply cleanly in the mid-320s. This heavy institutional absorption on above-average volume creates a solid floor for the stock, preventing deeper pullbacks even when broader market indexes face sell-offs. Understanding why this is happening requires breaking down the core business beyond the headline numbers. At its baseline, Tesla operates a vertically integrated business model spanning electric vehicle manufacturing, residential and commercial energy storage systems, solar generation, and proprietary autonomous driving software. Vehicles like the Model 3, Model Y, Cybertruck, and next-generation mass-market platforms generate the bulk of top-line revenue today. However, the true profit engine of the future rests on two specific segments: the energy business, where megapack installations are growing at triple-digit rates with significantly higher gross margins than automotive production, and full self-driving software, which carries near zero marginal cost per additional user. When you evaluate the historical performance, Tesla transitioned from a precarious manufacturing startup into a cash-generating behemoth capable of self-funding massive capital expenditures in artificial intelligence compute infrastructure without taking on destructive debt. This fundamental backbone creates the exact tension we see playing out on modern trading tools every single day. Investors logging into their Fidelity mobile app or reviewing SoFi stocks are looking at traditional price-to-earnings ratios exceeding 300, concluding that the valuation is far too stretched. They compare Tesla to legacy automakers and see a company that looks wildly overpriced. But institutions building long-term allocations through Schwab Intelligent Portfolios or using interactive brokers trading tools for algorithmic positioning are looking at a vastly different set of metrics. They see a company building custom silicon, accumulating billions of real-world autonomous driving miles, and locking down utility-scale battery deployment agreements that guarantee predictable high-margin cash flow for the next decade. This creates a fascinating dilemma for retail investors trying to figure out how to manage their portfolio strategy. Whether you are engaging in self-investing through a Robinhood app account, using SoFi ETFs for passive exposure, or running an active trading account on interactive brokers to build custom positions over time, whichever path you choose on your preferred investing sites, managing risk around stock market volatility requires understanding the gap between short-term noise and long-term fundamental execution. In summary, the narrative surrounding Tesla stock presents one of the clearest examples of expectation versus reality in the modern stock market. The prevailing retail expectation fears margin compression, rising competition, and slowing vehicle deliveries, but the institutional reality focuses on aggressive energy storage expansion, high-margin autonomous software scaling, and continuous accumulation during intraday pullbacks. As Tesla stock sits around $328.58 following Friday's market close, the long-term trajectory will not be determined by how many cars roll off assembly lines next month, but how effectively the company monetizes its AI compute power and energy grid solutions over the coming years.